Okay, we're going to get rolling here. So, good morning, everyone. Thanks for joining us. A couple of house cleaning items. Just make sure you're on mute. We'll have time for questions here at the end. I will also be monitoring the chat. So, if there's anything you want to talk about, questions, or something you want to remember so you don't forget, I'll be answering questions there as we move forward, and then we'll have some time at the end. So, again, welcome. This is presented by Capstone Land Transfer and our group of companies. For those of you who don't know us, we are located throughout South Central and North Central Pennsylvania, basically in the all the way Maryland line to New York border. We have offices throughout that region. You can certainly check us out on our website if you have any questions of where we're located and what we cover, but pretty much can do anything in Pennsylvania. We also have a legal team on staff and for any of your needs. So we have a paralegal that's been in the business who you're going to meet here in a few minutes. I'm going to introduce you to for 35 years. I'm Brian Zulli, and we've been doing this for about 25 years now. I'm an attorney. Don't hold it against me. Jolene would be very disappointed if I didn't say that to everyone. And we also have Derek Quick, who won't be joining us today, but he's been in the business for about 35 years as well. So one of the benefits of utilizing us is you have access to us to help create documents, try to figure out a situation, frankly, walk you through as an agent situations that come up, whether it's before, during, or after the transaction. How can we get the transaction completed and make sure everybody's protected? So we are here to help you. And with that, I'm going to introduce our speakers. So today we have Doug Foltz. Doug Foltz has been in the business for over 20 years. Most recently, before joining Capstone, was manager of a large Coldwell Banker agent in Lancaster. Some of you I see on the chat are familiar with him. Rick Hansberry, paralegal with Zulli Law and works with Capstone Land Transfer. Rick has been involved in, has been a paralegal, has been involved with real estate and business transactions for over 35 years. And our keynote speaker today, Brian Lesher. Thanks for joining us, Brian. He's a partner, CPA at LMS Tax Accounting, specializes in small to medium-sized businesses, and he will introduce himself, give you a little more detail here when he's up. So without further ado, I'm going to turn this over to Doug. Doug, you're up.
Thank you, Brian. Good morning, everyone. Appreciate everybody jumping on and joining us here today. Brian, thank you for the introduction. As Brian had mentioned, I come from the real estate brokerage side of the business. I joined Capstone earlier this year, and I'm the vice president of sales and marketing here. But in my prior life, I was a realtor, and then I was a broker manager for Coldwell Banker, and I dealt with the topic that we're going to be talking about here today, a number of times over my career. And it all kind of started for me, the whole idea of creating this presentation for everyone today was, partly through what I endured when I was an agent early on in my career. I remember once I started, getting productive, my accountant kept telling me at the end of the year, he's like, man, why don't you get your broker to pay an entity instead of paying you when you earn commission so that we can save you some money on taxes? And I took that back to my brokers at the time, and they're like, yeah, sorry, we can't do that. We can only pay you as a licensed agent. So, I kept, exploring this for a couple of years. And then lo and behold, I think it was around 2009. Sorry, I jumped ahead there. The Pennsylvania State Real Estate Commission changed their position on what they call qualified associations, where they made a provision that allowed realtors to file these entities with the state. They're not they're not licensed entities. They don't carry a license number like you do as an individual or like a brokerage does, but they do get registered with the Real Estate Commission. And what that does is it allows your broker to pay that entity directly instead of paying you as an individual. And we're going to go through today. We have Rick Hansberry, who Brian also introduced, who's going to talk to us about some of the different types of entities that are out there, some of the options that you're going to have. And then Brian Lesher, our CPA partner who's with us here this morning, is going to give us some of the tax advantages and really get down to the nuts and bolts of why this might make sense for you. So as far as process, when we wrap this up at the end of the presentation here today, we'll give you really the step-by-step on what it's going to take. But first step in this process is going to be, creating your entity or forming that entity. So Rick will explain those options to you. Your broker, as mentioned here in step 2, has to be on board. They have to understand how this works and be willing to, pay your commissions directly to that entity. I personally have never encountered any issues or reasons as to why a broker would not choose to agree to that, but it is something that they have to be on board with as well. Once that entity is formed, once it's actually created, then it gets registered through the state. And this is one of the steps that I find is a very difficult step for agents, because they have to remember what their PALS login information is for the licensing website. And for some reason, that's always a challenging step in the process for everybody. But once you get through that, then you're registered and set here as far as the state goes. So we're going to walk you through those different steps. I'm going to end up passing this over to Rick here in a minute. But before I do, keep in mind, as you're working with with the legal team to formulate this entity, there are some naming requirements that you have to be aware of. So I've had some issues in the past where agents would go to talk to their CPA or talk to an attorney who was going to help them with creating an entity, and they weren't familiar with the real estate commission's requirement for these qualified associations. So there are some important naming items that you got to be aware of. Don't use the term realty, don't use real estate, or anything else that would put you out or your company out there as an entity that might be providing some type of real estate service to the consumer. The moment that you do that, the real estate commission is going to kick it out. They're going to require that it's not something that would give that appearance as a real estate type of a company providing a service. So, you can do things like your name, you can do things like investments, anything that doesn't have to do with real estate is probably the best way to go about this when you're choosing the name of that entity. Okay, so let me go ahead and flip things over to Rick, and Rick can walk you through what some of the different options are here with creating that entity that will be filed with the Real Estate Commission. Rick?
Good morning. It's nice to have you with us. Everyone has a guy. When you're buying a car or buying a house, I got a guy. I would call a guy. Well, I want to be your guy for entities. I've been a paralegal for 30 plus years, and I've filed thousands of entity formations. The Department of State of Pennsylvania regulates that, so I'm familiar with just about every type of entity that you could encounter. As the slide says, I also have a significant amount of experience in corporate law and intellectual property, which is really just copyrights and trademarks, but it does play into names. And I'll walk through the right business structure that might be right for you, but also give you some options there and navigate that formation process. So I look forward to possibly some questions if you're unfamiliar with it, or if you've only had limited exposure to entities and owning an entity. I'm here to make it a little bit easier and hopefully answer all of your questions. So there's a couple of things to think about when you get to entity types. Think of an entity as a separate taxable being that can't think for itself. So it needs somebody to tell it what to do, and that is the owner. So within that, there's structure, there's liability, there's tax implications, but you as the owner of that entity need to tell this taxable being how to operate. So when you're a separate entity, the one thing you're doing is insulating yourself from liability. When an entity owns something, your personal assets are shielded from that. As long as you are operating the entity in good faith and doing the things you're supposed to do, your personal bank account, your car, your personal assets are shielded from liability. That is 99% of the reason why a lot of people form entities. There's also tax consequences. I prefer to use the term options because you can do a variety of things to work for your particular tax benefit. The ease of formation and maintenance kind of goes back to having a guy. Yes, you can complete the forms yourself online. Anyone over the age of 18 can form an entity in Pennsylvania, but I've seen a lot of people come into me with binders from LegalZoom saying, can you help? I checked the wrong box or I did this wrong. So ease of formation, it does help to have someone who's familiar with what these various terms mean. Capital raising and ownership flexibility is something that you may or may not get into if you have other owners in your entity. But we can talk a little bit about that. Continuity and succession. You are doing a little bit of estate planning by forming an entity because it lasts perpetually in Pennsylvania. So it becomes an asset of yours that will become part of your estate and can be passed on down to your children or spouse or whomever if you choose to. And then the regulatory and professional restrictions, which Doug alluded to. But at the same time, there's a couple of other things that we'll talk about. The main entity types are set forth before you. We can talk about any of them if you have questions. Most of you, if you're operating right now, may be a sole proprietorship, which means it's you, or maybe you have a DBA name. But that means that you're essentially using your social security number as a bank account, or maybe you have one for a DBA. A partnership is basically you operating as a proprietorship as well individually, because with partnerships, there is no insulation shield or liability protection. A partner is responsible for another partner's actions with a general partnership. Other types of partnerships are available, but a general partnership, if you have a partner, you're equally responsible, even if your understanding with that partner isn't 50-50. A limited liability company is probably the most popular and one we'll spend the most time talking about, but it is exactly as the name implies. It limits your liability. It is the same business benefit and same structure as a corporation, except it has the flexibility of a partnership. There are numerous ways that ownership and management can be handled. So a limited liability company is frequently the best choice for small businesses going forward in Pennsylvania. And we can talk about the others too, if there are questions about that. A sole proprietorship, just running through those, is basically just operating the same as if it were a lawn mowing business or a babysitting business or a pet walking business or a real estate business. It basically is something where you're making the decisions, you're operating the entity. You might have a separate tax number, you may not, but the disadvantages are that unlimited personal liability, limited capital, no continuity. It's workable, it might not be the best desirable. Partnerships, that is basically you and I or you and someone else deciding, you know what, let's do business together. And you could walk out of that room and have a partnership. You don't even need to file anything with the state. You don't need to have a written agreement. You can basically just decide, we're partners. We're sharing everything 50-50 and we're going forward. Sure, it's easy, it's flexible, it's unspoken, there's no written language, but it only works when everyone's happy and nothing goes wrong. So reducing it to even a limited partnership or a partnership agreement is probably the better way to go, just in case something does go wrong and everyone understands who's going to do what then. A limited liability company kind of encapsulates that concept of having flexibility of different partners doing different things. Maybe one's a sweat equity, maybe one is a business owner, but the insulation of your personal assets is the huge draw of a limited liability company. You can appoint managers, which would be someone other than an owner if you decide to structure it that way, but you don't need to. Members are synonymous with owners, which are synonymous with shareholders in a corporation. A member owns the entity and derives the benefits from the profit and loss of that entity. The default of pass-through taxation, Brian's going to talk a little bit more about that, but there are different ways you can elect to be taxed, even if you are a limited liability company. A lot of people think, oh, I can't be a sub-S if I'm an LLC. You can't. So there are advantages to being a limited liability company. You don't need to have partners. It can just be you, even if other people are working for the company. So that is the most popular choice, and we'll spend the most time on that. Corporations are still an option. There's two types of corporations that a lot of people are familiar with. A C-Corp is basically more of a public corporation where they're shareholders and they're essentially taxed at two different levels. They call it double taxation, because you would pay taxes on the money that you make from the corporation, and the corporation is also paying taxes on its revenue. Whereas a sub-S corporation with the pass-through means there's only one level of taxation. All the profits and losses flow through to the individual owners. So they're the ones that pay the tax on the profits and losses. Professional corporations, well, that's Zooey law. When you're a licensed professional, you have to file a professional corporation. So accountants, doctors, lawyers, if they form an entity that you're a licensed professional, you form a professional LLC or corporation. And that means that only a licensed professional can be an owner. You can't have a non-licensed professional as an owner of a professional corporation or LLC. The non-stock corporations and other annotations, I just wanted to make sure that realtors and the real estate licensing commission entities that we're talking about are not part of that. So you wouldn't need to be or have to be a professional entity as a real estate association. The key considerations, other than what Doug mentioned at the top of the naming, and I'll add to your list of investments, holdings, anything without the word realty or real estate or properties in the name is probably going to be okay. But the entity selection comes down to ease, it comes down to familiarity, and it comes down to what you actually hope to do with this particular entity in terms of revenue and in terms of taxation. So how does it happen when you've got a guy? You call the guy and say, this is what I want to form this entity. Pennsylvania has a requirement that they can have duplicate names of entities at the state. So what they do is when you form an entity, you get exclusivity of that name perpetually. Now, similar names can work, and the Department of State basically says if it's at least 2 characters different, and like say there was an entity called Clark Investments, well, they will accept Clark Investments Roman numeral 2 LLC, whatever. If they decide that there's at least enough of a differential, it can be what you would call a similar name, but there does need to be some differential of your name. I always ask people to give us at least 2. It's free to check, and the Department of State website is pretty user friendly. You can check that yourself. The forms are actually online as well. Basically, to form an entity, you need a name, and you also need what they call a registered address. In Pennsylvania, you cannot use a post office box for a registered address. You can use your home address if you don't have an office, or you can use a business address. It just needs to be a physical location. The word registered really means that is where a sheriff would show up to serve process if the entity were ever sued. So that's why it needs to be a physical location, but a name and an address are two of the key components to forming any type of entity. Once that document is filed with the state, then you get what I call that separate taxable entity. That would be the EIN number that's associated with that entity. Then the internal documents, which are basically the evidence that you are the owner of the business and that you are the decision maker, or who those people are if it's not you. So the recommendation would be to form some type of insulation entity. We can go over, again, particular circumstances or situations, but having some type of protection for yourself to shield that liability and also offer you some certain tax advantages would be desirable. It also establishes a tremendous amount of credibility. I think public perception means a lot. So when people see that you've gone through the legal steps to form an entity, it is inspiring confidence in the people you're dealing with. At this point,
Rick, before you transfer over to Brian Lesher, Brian Zulli, do you want to jump back to our the liability piece quick and just give the agents that are on a call a little overview of how the liability helps with their profession?
Yeah, I think there's two things to point out here. As a real estate agent, one of the things the Real Estate Commission was concerned about was liability issues. So if we created an LLC, what does that look like from an agent standpoint? So one of the situations with a qualified association, basically the one thing you cannot avoid as a real estate agent, even if you're getting paid in an LLC, is you cannot avoid liability for anything you conducted as an agent. Now, granted, if you're using this LLC to also buy a property or to do something other than receive your commissions, you'll be insulated from liability as Rick described. But for any actions as a real estate agent, there's a carve out there for the qualified associations. So that was one of the concessions that was made when they created this opportunity to help you get through some tax consequences. The other thing I want to point out is those members of that LLC, one of the questions we receive all the time is the members of the LLC can only be members that are licensed under the same brokerage. So, and you have to be a licensed person you couldn't have, for example, your spouse join in this LLC if they weren't licensed and with the same brokerage, because obviously payments can only go to brokers can only pay agents. So those are two little nuances here when it comes to qualified associations.
Okay, thank you. Okay, so now we're going to get into the tax part. So first of all, thank you, Brian, Doug, for having me. Rick, great job on the entities. And now the fun part with the taxation. Just a little bit about me. Been in public accounting since the year 2000. Born and raised Lancaster County, went to Millersville. So, certainly in this local area here my whole life. Our firm has 9 employees, or there's 9 of us in total, specialized in taxes, obviously January to April. That's our main focus. We do a lot of tax planning, payroll goes with it, anything that helps small businesses go. And then a lot of tax planning as well with that. So Today, what we're looking at is specific tax advantages of being taxed as an S corporation. And then maximizing savings while maintaining compliance, which is a key part of this as well. So Rick went over all these different entity types. He gave us so much information. From a tax standpoint, what I'm focusing on is the best tax saving structure. In most cases, we're looking at this LLC with an S-Corp election. What's this mean? This means you're that limited liability that we went through, but yet the IRS is going to recognize us for taxes as an S corporation only. Why do we like this structure? Really simply, the benefits of the LLC versus just the straight S Corp is the simplified administration. You don't need a board of directors, no annual minutes, just fewer formalities than having a corporation. You don't have to have a corporate seal, like all these things that just require more time, more costs that are not necessary to get the tax benefits. So the biggest tax benefits, tax pass-through taxation under that subchapter S, with the big two things that we're going to look at are self-employment tax savings and then local tax savings as well. We're also going to get into some additional tax benefits, some health insurance, some other things that can really help you out in minimizing your total tax liability to the IRS. Pass-through taxation, what is it? How does it work? Basically, what we're looking at is the profits from your LLC, your limited liability company, flow through to your personal tax return. And then all the taxes are paid at the individual level on your 1040. The benefit of that is you can potentially net. Well, first of all, the first benefit is lower tax rates. Your individual rates are lower than corporate rates. You're avoiding that double taxation. But you can also offset different types of income on your individual side. For example, if you have some real estate that loses money, that will offset your profits from your business showing a profit. Stock losses up to a certain amount, capital losses. There's all sorts of things that can potentially offset your income and lower your tax liability. What is the self-employment tax savings? That's kind of what we're going to get into right here. What is that savings in terms of numbers? So in this LLC, that the IRS is going to recognize you as an S Corp, owners are going to pay themselves a reasonable salary. So you're going to get a W-2 from your entity. The remaining profits of your LLC, those profits that are calculated after you take your salary, so you have your gross income, those commissions you're getting, you still get to deduct all your expenses, your MLS fees, any advertising, any potential meals, stuff like that, your mileage, things that you're normally deducting, you still get to take. But that remaining profit is not subject to the 15% FICA tax, 15.3. FICA tax is just your Social Security and Medicare tax. So just a simple example using nice even numbers. Let's say we have a $100,000 profit. Our gross can be, a higher number, 200,000. We have expenses. Our profit after that's 100,000. So working with our accountant, we come up with a number that, hey, our W-2 salary out of this LLC is going to be $40,000. So that remaining $60,000 is not going to be subject to that 15% FICA tax. So you're looking in this example of $9,180 in tax savings. And this is a very simplistic approach. There's a lot more that goes into this. It's really important to work with a CPA with this or work with your accountant, because there's all sorts of other things we factor in, like rent and potentially other expenses. So this is just kind of putting at its most basic format is, hey, there's potentially a lot of money out there that we could save in taxes by utilizing this entity approach. The other piece of it is local tax savings. This number isn't as big, but I just thought I'd mention it because, you know, any taxes not paid is a good thing to me. So what we're legally, of course, with the attorney here, legally. So what we're looking at is, okay, in that same example, we had 100,000 profit. We have the 40,000 of wages. So we have 60,000 of S corporation or LLC is going to have 60,000 of profit left over. As of right now, the local tax agencies do not charge you tax on that profit. So in Lancaster County, the majority of Lancaster County, it's 1%, 2% in Harrisburg, and in Reading, if anyone's out there in the city, it's as high as 3.6%. You're saving that 60,000 times that local tax rate in terms of some additional savings there. Once again, not the big number, but hey, every dollar helps. Looking at other than just the tax savings, where can we gain a little bit as well? Because once again, you know, you're paying your accountant to help you not pay tax where legal. The one thing is health insurance. When you're a sole proprietor, you can certainly deduct health insurance. Without trying to get too technical, it's a page one deduction. Running it through your LLC, potentially you get some state, local benefits, as well as some additional items. And then basically I'll hit I think Doug wants to talk about the Capstone benefit program potentially as an area here where we could get some help through Capstone.
Yeah, Brian, I'll just jump in here real quick. You know, we do have an option for real estate agents to partner with Capstone and work with us in a different level where you have the opportunity to actually purchase shares in our company and share in the overall profitability of our entities. And one of the things that comes along with that is the opportunity to jump in on our group health insurance plans. So this is something new that we were able to uncover for our members over the course of the last several months, and we're really excited to be able to talk to folks about that. You know, we are coming into enrollment season where it is time to, for people to look at, what they're doing for the new year here with their health insurance. And if this is an area that you're struggling in or need some help in, we'd love to talk to you about what that might look like if you were to become a member with our company.
Thanks, Doug. And then I just put retirement plans on here. These things exist both inside a sole proprietorship and inside your LLC as well. There is some additional changes that would happen with going to the LLC, but you still have your SEP, your simple, basically company-wide plans that we can do some employee matches with now you're on payroll. So once again, this is where you need to utilize your accountant and your CPA to make sure, hey, we're getting every dollar we can put away in different buckets to make sure that we're giving as little to the IRS, the state, and local as possible. This is just kind of discussing reasonable compensation. So with your LLC, you're going to be on payroll of that company for a portion of the income that this entity is going to make. So basically what we're looking at is we want our salary to be as low as legally possible to not get you in trouble with the IRS. So basically the IRS is requiring salary to be reasonable. In any case law that they've won, basically what we're looking at is what's the profit of this entity, how much are the owners pulling out, and basically coming up with some sort of median amount for salary versus distributions. Once again, work with a tax professional. The other big thing we've seen with people in your profession, especially with these LLCs, it's just making sure you're separating business and personal transactions. When you set up this entity, you're going to open up an LLC checkbook. Your commissions are going in there, and then only business expenses should be coming out of there. And whenever these things start, there's always questions about what is business, what's not. We will work one-on-one with people to figure those out. But like your mortgage payment on your house, that can't be coming out of the business account. You have to take draws out of this company to make it legal that we're separating both our business and personal. So that is a key component of this. We do need some discipline with this separate entity that we're creating. And once again, bouncing that salary and distributions, maybe paying yourself some rent. Doing these things is how we want to maximize your tax savings with this entity. So basically looking at, is S corporation election right for you? This is just talking about the LLC and then having the accountant do the S election. Does it work? Basically ideal for small business owners seeking tax savings and still having that liability protection. And then really, once again, can't emphasize enough, don't do it yourself. Payroll's fairly complex. Doing the corporate tax return is complex. Make sure you find someone to work with to kind of help you through this whole situation. The implementation, hopefully you go to Rick. Rick creates the LLC. Then you take that to your accountant. The accountant will file your S election within 60 days. It's due within the entity being created. With that LLC, in terms of tax filings, every year you're going to file what's called an 1120S. It's an additional tax return. It's a detailed tax return. It's not something I've really ever seen someone handle on their own successfully. From that tax return, basically, it'll generate a K-1 and a W-2 that you'll need to file your personal taxes. This will replace, perhaps most of you are filing as a Schedule C. These two forms will replace that Schedule C inside your personal. So basically, file the business, then you file your personal. When I have clients, I generally do them both at the same time. I will file the business, I will rough up the personal, and have the personal done at the same time. So each of my clients is getting two different sets of tax returns pretty much from us at the same time. And then payroll management, with you now getting a W-2 from this LLC, there is payroll requirements where you have to file payroll tax returns quarterly. There's some unemployment taxes, local tax, state, federal. You really just will need some help with that as well. Looking at your timeline in terms of getting everything set up, first, act now. If you're looking to do something in 2026, the beginning of the year, can't encourage you enough. Don't wait till December 30th. Don't wait till January 15th. You want to kind of get that process started today. The way the timeline works out is day 0 to 7, you're creating your legal entity, reaching out to Rick, getting it created. And Rick can put a date of January 1st on this paperwork. So getting it started today doesn't really change anything for this year. It's just getting everything in place for January 1st that we're ready to go. As soon as you get all your legal paperwork, you're going to open up a bank account. Then once you're at that point, you come see your accountant. Brian comes in, I'll file an S election with the IRS. We'll do all the payroll applications and get you rolling. So really in that process, other than coming up with your own name, there's really little that you as the business owner has to do other than, just getting the process rolling. And then last step, days 4 through 30, once the paperwork comes back from the state, you're going to contact Doug if you need help filing the QA with the PA Real Estate Commission, which we'd strongly encourage you to do. I think that's all for my part. Do you want to go over this part, Doug, or?
Yeah, I think, thank you, Brian. Really appreciate you going into such detail. Rick as well. Hopefully you guys found this to be helpful to really lay the process out. We do want to open it up for some questions and get some additional information out there that you guys might be curious about. One thing I'll just add here. Obviously, we live in an age of technology, and I don't know about you guys, but we're big AI nerds. We love jumping in and trying to see where we can solve some things online without going through a tremendous expense or having to go outside for something. And this is an area where it's like, hey, you can go online, you can find some information, you can do some things on your own, or you could go to somebody that is going to just kind of piecemeal this thing together for you. But what we're really hoping to do here today was show you a roadmap where you have a team that's going to be here to help you through each step of the process, because there are some nuances that were alluded to throughout the presentation that are specific to the real estate industry. And when you just talk to somebody who's a general accountant or a general attorney who doesn't know those nuances, it might lead you down a path that is going to cause you to have to go back and start all over again. So just want to throw that out. We're here to help. Our contact information was on that previous slide, and we'll bring that back up for you guys here in a minute. But let's open it up for any questions. Feel free to take yourself off mute, jump in, and let us know if there's something we can help to answer for you.
Hi, can you guys hear me?
We sure can.
All right. Hey, this is Jill Fuller. I wanted to ask you, and you may have covered this and I may have just missed it, but when I got into real estate, I came in as an investor. And so I had been recommended to form an S-Corp like 5 years ago for my investment business. And I did it and then didn't make enough money and it ended up being a headache. So do you recommend a minimum amount of income you should have before you form an S-Corp?
Yeah, let me flip this back over to Brian and I'll let him take that question from here.
That's a great question. So generally what I tell my clients is we need a profit. So your gross commissions minus your expenses, we need a profit of 60,000 or more to make it worthwhile. So on your Schedule C, when you look at that, if you're at 20 grand, 25 grand, 30 grand, you're not in that target zone because you're going to have additional costs, the payroll costs, the additional tax return costs. So really you got to be making enough profit to make it worthwhile. And the first step, if anyone comes to me and says, hey, Brian, what do you think? I'm going to say, hey, send me a copy of last couple years tax returns and let's do a cost analysis real quick and figure out if this makes sense. The other thing is this is not an answer if your passive income, if it's just holding real estate and rentals and stuff like that, the S corporation isn't the way to go because this is just a way to get away from self-employment tax. You're looking to avoid getting that self-employment tax on active income, your commissions, that type. So, once again, that's a great question. This isn't for everybody. If you're just getting started out, and your taxes are not that high, this might not be the choice yet, but we'll certainly make sure you get there.
And one other thing that I wanted to at least clarify with Brian here to make sure I'm not misspeaking, but your tax election, once you say I'm an S-Corp or whatever, if that changes, you can change your taxation each tax year, correct?
At the beginning of the year.
Right.
Yep.
So
Okay,
you're not
great.
locked in forever and ever.
Does that make sense to you?
Yep. Yeah, it does. Yeah. I went through that process, but yeah, it was for an active real estate business, but no one told me about all the extra fees. And so it just didn't end up making sense for the amount I was making. So yeah, that clarifies it. Thank you.
No problem. It's a great question.
Awesome. What else we got? Other questions?
I have a question.
Yeah, Logan, go ahead.
Hey, Logan Hutton here. First, I want to start off by saying thank you so much, Capstone and Brian, for doing this, because this is something that I think is so important. And it just came into my head recently that, hey, I'm actually making some money now. Shit, I'm going to have a massive tax bill. How can I get away from having to pay so much in taxes? So I think this is very, very good stuff, and I appreciate you guys putting this on. My first question, on a couple slides back to your example of a net of 100,000, paying yourself 40,000 W-2, what happens to that leftover 60? So like if I'm paying myself 40,000 but need 50,000, how can I get that extra money? Where's that go? Does that make sense, that question? Sorry.
Yeah, there's two ways in this entity structure that you're going to get paid. Well, there's more than two. There's multiple ways, but your main two ways are you're going to get paid through W-2. So in that example, your profit's 100, you're paying yourself 40 grand W-2. The other way you're going to get paid is distributions. You're just cutting yourself a check for the other, 40, 50, 60 grand, and it's called a shareholder distribution. It's a distribution of AAA, but it's just called a distribution, basically.
Okay.
So
one more question
Yeah.
on this before and then I'll stop because I'm sure other people have
No, you're
more
good.
questions. So I go through the steps, get the LLC set up, meet with you, meet with Doug to help me get into my pals after I remember my password. I'm assuming this isn't for any income I made this year. This is all from next year forward.
Correct. We're too late in the process for 2025. You're basically looking to get this in place for 1/1/26 and to utilize this because you have to get it set up through the state. We have to get payroll registered and running. You have to get the commissions transferred. Once you get it through the real estate commission, you have to start getting the 1099s issued to your new company. So we can't go back and pretend the last 10 commission checks were from to this company. It would just be from this date going forward. So if you're looking at tax planning for 2025, your biggest things you can do is where is there business expenditures that I can make to bring profit down. Looking specifically at money going out of your account, and I would really be looking at is there a way to open a retirement account to get a bunch of money put away. You potentially can do a SEP where you can put up to 25% of your profit in. You can do a simple plan where you can put maybe up to like 20 grand away. So there's still things you can do for 2025 that it's worth sitting down with a professional, but really this whole thing that we're discussing would be for 2026.
All right, I lied. One more small question. So my tax guy now doesn't do any of this stuff. He only does, I guess he doesn't do corporation stuff, so I have to go somewhere else. So are you taking new people?
Yep.
All right, cool. That's it.
You have my information. What I would say is reach out to me via email or phone call. I'm going to want a copy of your last couple of years tax return, which I can send you a secure link, and then we'll take it from there. We'll have a meeting either in person or via something like this.
Any other questions? All right. Well, I do want to just give a special thank you here to Brian Lesher from LMS for joining us today. We really appreciate you, jumping in and providing all this great information for our realtor partners out there. If there's anything at all that we can help you guys with, please don't hesitate to reach out and pick up the phone. Anything throughout this process or anything related to the title industry or real estate industry, we want to be your partner in your business. So we're here to help. Try to put all the pieces together and help you in whatever aspect it might be. Brian, anything else that you have on your end before we wrap up?
Which one?
Let's go, Brian Zulli. How about that?
No, nothing else. But guys, this is what we try to do here is to help you out in any way, shape, or form we can. I mean, we take calls all the time. Anything comes up, throughout a transaction that you need assistance with, that's again while we're here. So, thanks again, and hopefully we'll take you.